definitely learning about how to do all of this, and it isn't high tech. But well, at least you get it on. At least you get it recordings. Do you have any other classes that people tape their lectures and put it up on YouTube? There's none of that.
No.
It seems to me it's like a natural. It's a natural thing. Why not? I mean, it's the camera. It's free to put it up. It's free. Everyone can access it. I don't know, but I think it's certainly a wonderful opportunity. I think maybe part of the problem, people are worried that no one comes to class, but I think that's the point. You have to give people a reason to come to class, and not just because so that they can write stuff down. And maybe that's what people are afraid of. At any rate, what I'm going to talk about, I'm kind of delaying to see when they come in, but I think I'll get started. What I'm going to talk about now is this lecture. I'm going to continue to talk about the process of the Great Recession, and what I'm going to talk about today is how it was different. How it differed from the Great Depression. So the difference between the Great Recession and the Great Depression. We've talked about the similarities, and what's interesting is that from a technical standpoint, from the standpoint of looking at the development of technology, the events are very similar. So we've talked about the development of electricity, electrification, and how the anticipation of the use of electricity in society and in manufacturing brought about the great boom of the 20s, the stock market boom, a little bit of excess anticipation, the stock market crash, and the Great Depression in 1929, and then the Great Depression of the 1930s. And then the parallel of the development of computer technology from the 1940s through the 1990s, and again the anticipation of the benefits of computerization on the society and on economic growth, and again an expectation that was too soon, and again a bidding up of assets, and a crash that occurred in 2000. So we had 1929 and October 1929 and February of 2000. So pretty basically 70 years apart as to when those two events took place. Very similar to the peaking of the equity markets in both of those eras. Now the difference was that a Great Depression, we're going to look, the difference was the policy response. The policy response to the Great Recession. And what's important about this difference is that the policy response to the Great Recession seemed to make it not as severe of an event as the Great Depression. It was not as traumatic of an event for the societies, for the global economy, as was the Great Depression in some ways. But what we're going to show is that in other ways, all that really took place was the activities, the actions of the central banks simply created, instead of, where in the 1920s, the bubble that was created by the stock market bubble of the 1990s, late 1990s, I'm sorry, of the late 1920s, that bubble burst and it was over. So that bubble, it was a bubble, it blew up, and then you had the aftermath. So you had a stock market run up, stock market collapses. That's the 1920s. The differences in the 2000 was you had the stock market run up. You had the stock market run up, similar, and a crash, but some support, especially for other assets. And we're going to see in particular the real estate market. The real estate market was supported by the activities of the central banks, and particularly the Federal Reserve Bank. And what we're going to do is we're going to see the difference. And the difference in policy and the difference in outcome. And what it tells us is what we ultimately want to do here is to see, well, where do we go from here? What's going to happen in the world, the global economy, from here? So we'll start, and I'm going to talk about the real estate market. And this is the difference. We're going to see that the big difference in terms of the collapse of the bubble of the 1920s and of the 1990s is the difference in the real estate markets. And so this is the first. If you're interested in housing prices, this is one of the great data sources of data, long term, of real housing prices. And this is an index that goes back to 1890. And what it is this is a Case-Shiller index. This Shiller is Robert Shiller. He's a Yale economist at Yale University in the United States. He's won a Nobel Prize. He's a Nobel Prize winner in economics. He along with another professor named Case, put together, and they had their students work on this. And what they got was transactions of housing market transactions, and they took the same houses. So they took the same houses, and they looked at resales of houses, and they went back to the 1880s. And they got transaction data. They were able to go back and get transaction data on the sale of houses. So they looked at the same house that was sold, and they developed, so to develop a market that was based on what we call apples to apples. It was an apples to apples comparison. You're comparing the same unit. So if you have the same unit and it sells 10 years later, then you can make some comparison of the change in housing market, housing values. And that's a very good indicator of the real housing market. And so what they did was they put together that index, and it's for the entire United States, and it's also broken down into it's done at the quarters. Every 3 months, they make this index, and it goes back to 1890. In 1890, it's a base of 100, so it's an index, and it's real. It's adjusted for inflation. So there's the adjustment for inflation. So it's the real price of single-family residential homes in the United States. Okay, so the base here, as they say for the index, is 1890, and that's 100. So the interesting thing is we look, and we can see 1920. Because that's where remember we started our analysis, 1920, we looked at the asset markets, we looked at the economy, looked at what's going on. The interesting thing was real estate, in real terms in 1920, was 35% lower than in 1890. So you had the index of 1890, 100 in real terms, residential housing prices in the US were 35% lower. And this was at a time of great population growth. So population growth, there's a rapid population growth, rapid technological growth, the expansion. Cities are growing rapidly. The economy it's a period of significant growth. A lot of it, huge immigration. You're getting a lot of immigration in the United States. Housing market prices actually falling. And the interesting thing is we can see here, it's really, this is 1930, there's very, very little change. In real terms, very, very little change. And the interesting thing is you can see, at least in real terms, there was not much of a decline from the Depression. Now, there was deflation. So if you look at the nominal value of real estate, the nominal value dropped. But that was because there was a lot of deflation in the economy. Prices were in general falling, but if you adjust for deflation, for the fall in prices, there was very little change. So very little change, and until really during the war, after the war, and you get You get, it goes above 100 at the late in World War II. So now, late in World War II, we finally get some increase in real housing market prices in the United States. But you can see, if you compare this to, our, let's see if I have that. Well, if you compare that with the change in the stock market in 1920s, stock market's did like this, it would have been way up there in comparison. There's nothing. There was no impact. That bull market had no impact on housing prices in the United States. So that's the important thing to remember. So we don't see until really, see by here, in fact, the Depression is over. World War II ended the Depression in the United States. As a result of the wartime, the wartime production, that was the end of the Depression in the United States. Housing market prices start rising. Residential housing market prices start rising. Now I want to look at, we're going to the 1955 to 1994. So now it's post, and now I've got it by quarters. This is the, no, I think I've done it by monthly. I might have done this by monthly here. That's why there's so much movement. Or you can see the short term, a lot of short term movement. Again, 1890 was 100, but you can see 1955, 1960s, 1969. Here's the 1974. This was actually around the time of the first oil crisis, or 1970s. This was the worst recession. This was the worst recession since the Great Depression, at least to that point. But slowly declining, but fairly stable, and kind of close to 100. In fact, if you think about it, this is 1975. You're basically at 100. So what that means is that in real terms, from 1890 to 1975, 85 years, it was basically, in real terms, zero growth in residential housing prices. And actually that makes sense. That makes sense because cities can grow out. The housing market is not a great long-term investment. And typically, housing, the long-term, it's not a great investment compared to other investments. Here, real term, if you had bought a house in 1890, and if you'd lived long enough to 1975, in real terms you would have grown with inflation. The value would have gone up with the change in inflation, but in terms of real growth, almost zero. So now we see, late 1970s, we get a little bit of but not much. It's still well within historical ranges, and moves up. Then we get this. This is the 1984, 1980s, 1985. But this is now the late 1980s. It's called 1989. Anybody remember what was going on in 19? This was an all-time high at that point. August 1989, all-time high 131. So the market's now 131. So prices are now gone up basically in 14 years, 30% in real terms. What's going on in 1989? Anybody think? Japanese asset bubble. Japanese asset bubble. This is probably the effect. The Japanese asset bubble had a real effect, a global effect on real estate markets. It affected, money was flowing all over the world as a result of it. And I think that, and one of the messages that I want to make, and I've tried to make this year, is that when you look at this era of economic history, I think we're going to look back and see that the beginning of all of this, of all these bubbles, which have which I think we're still going through, that was the first one. The Japanese asset bubble in the late 1980s was the first bubble, and it's something that we've seen over and over again now, ever since. We've seen the Japanese asset bubble, the Asian financial crisis, the dot-com bubble, and now we're seeing another real estate bubble. These bubbles now have been going on for almost 30 years now. But I think that's very much what's going on there. But then, no, it's interesting, but it comes down. It comes down again. And what's interesting is that so this is the Case-Shiller index here. This is the NASDAQ index. And you see that now I've just got the, and this is, I believe I've adjusted, yeah, this is adjusted for inflation. I've adjusted the NASDAQ for inflation. So the real NASDAQ, the real NASDAQ is, it reached like 5,000. So this is an inflation adjusted index. But you can see that while so it dropped, but so around that time now, so real estate prices now began following, which is different. It was different than what happened, as you recall, in the 1920s. There was no reaction in the residential housing market, whereas here there was clearly this very similar movement. Not only did we see that, so here's the asset prices of the housing, of the stock market, tech stock market, and very, very similar. It followed very closely once this took off. Once the NASDAQ, the tech bubble took off, then real estate prices, residential housing prices in the US began rising. Now we're looking here, we're seeing how that, here was Fed, now what I want to look at is the GDP growth rate. And we're seeing in the early 90s, this is the US GDP growth rate, and we're seeing a trend throughout the 1990s that there was this growth in GDP. And by the end of the by the end of the 1990s, we were averaging about 6%, about 5% a year in terms of the trend line. So this was part of it. You had a fairly booming economy. Economy was starting to boom. You were seeing, and also I think one difference in terms of the residential housing market in the 1990s in the U.S. was that there was less space to grow. The cities had grown a lot compared to the 1920s, and I think there was less. So there's less space. There's more restrictions on development. I think this is also a factor here, as opposed to the 1920s. But we can see here the economy is growing, but the residential housing market is falling. You see how the economy is growing from kind of depressed. Let's see, there's kind of a recession. This was a recession here, early 1990s, recession in the United States. Then the economy is in general, you see the trend line up. Residential housing market falls, and it's really, and my point here is it's not really responding to the growth in GDP. It's responding to the housing, it's responding to the tech market. It's responding to the tech market. People that are making money in the stock market, are buying residential real estate. That's probably the story. People are making money in the stock market, they turn around, they're buying housing, residential housing, and driving up residential housing prices. But as we know, so that was all a bubble. So that's all, that was all a bubble. Now I also want to look at, I have here's the Case-Shiller index, again that's in blue. here, and now I'm comparing it with the construction share of GDP. So I'm looking at the construction share of GDP, and we can see you're getting a residential housing boom. You're getting a housing boom. And what's interesting there is that if you recall, remember we talked about that there was a housing boom in the United States in the late 1920s? I did mention about that. I didn't show you, I don't think I showed you any data. But there was an increase in construction. I talked about in the office market. There was a boom in the office market, office market construction, housing market construction. That is the construction share of GDP and residential housing prices. So that was a similarity. So we see that similarity. Late 1990s, increase, so construction market, that's going up from 4% to 4.7%. That's a lot in those kind of movements and you're going from 3.8, almost 1 percentage point. In construction market, those are big movements. Those are fairly large movements in the construction market where you get that kind of increase in share of GDP. And you can see the housing market now is starting, the housing market's rising, construction is responding, so there's a boom in construction, residential housing part going up. So you can see people are making money in the stock market, running out and buying residential housing, single-family residential housing, and builders are running out to develop. Well, needless to say, that's kind of a recipe for problems. In the long term, that's a recipe for problems. Now I want to look at the Fed policy, the policy of the Federal Reserve. The Federal Reserve job, one of their jobs is to control inflation. Another job is to allow the economy, is both economic growth and inflation. That's their main objectives. And so for most of the history of the Federal Reserve, and that is until very recently, which we're going to talk about later in this lecture, the main effect that the Federal Reserve has done in order to affect the economy is through the federal fund rate. This is the federal funds rate. This is in green. That's the short-term interest rate. So those are short-term interest rates that the Federal Reserve does to lend to banks. Where you can see, and one of the things that you can see, they're quite high, late 1980s, 8%. Got a recession. What does the Federal Reserve do? Central bank do when you have a recession? You cut interest rates. Cut interest rates, make money cheaper to stimulate the economy. This is what central banks have done for a long time. So they're cutting the interest rates, and you can see the response. Interest rates are cutting, they get down here, and now you can see that response. And typically that historically is the response to these interest rate cuts is the Federal Reserve and other central banks are able to affect economic growth by doing that. The important thing to remember here is that when you have relatively high interest rates, you can do that. Now what's interesting to remember is that in Japan, by this time, during this period, interest rates were cut to zero. Once you cut interest rates to zero, the central bank kind of runs out of policy response. You can't do very much if interest rates are already zero, you can't cut interest rates. And what we'll see is what the Federal Reserve and the other central banks of the world did in response to that situation, which is unique in financial history is what we've seen in the past 10 years. Is something we've never seen before in the history of finance. And we're talking about going back 800 years of financial history. Is what we're seeing now, what we've seen in the past decade, is absolutely never occurred before. But at any rate, so we're getting down, it's 3%, so they've cut the interest rate, the federal funds rate. This is like the overnight funds rate, so that can shift a little bit. Now they've seen a little bit of the rise, so they're rising interest rates. They want to keep a fairly stable growth rate. That's what the job of central bankers. Central bankers see that they want to create, to adjust interest rates. It's like adjusting the flow of tap water to keep the level of the water. Say there's water running out, so you put enough water in to keep it at the same level. That's kind of the idea. And cutting the interest rates means you increase it's like turning up the amount of water flowing into the sink. So, and then when the sink starts to get too full, because you don't want it to overflow, then you tighten up, you reduce you increase interest rates, reduce that, it's like reducing the tap, the amount of water in the tap, and then that keeps to try to keep the level at a fairly steady rate. So if you look, once you get to this point, you got about 6%, your federal Fed funds rate is about 6%, mid-1990s, stays fairly steady, and see how the economy too. So the economy actually, although the trend, when you go from here, but if you make another trend line here, it's actually going to be quite flat. And this was called, and at the time, this was called the Goldilocks economy. Let me see, let me get that. This was like the central bankers, the story of Goldilocks and the Three Bears. Anyway, but Goldilocks was like the idea, the perfect world, where the economy is growing. It's like the wish of central bankers is to have just the interest rates at the perfect level that keeps economic growth just the same forever. That's what they want to do. And so people were talking about this Goldilocks, this wonderful world where now we're going to have forever and ever and ever, we're going to have steady the economies were going to grow at the same level, and it was going to be a wonderful world for forever and ever and ever. So that was the situation in the late 1990s, and especially with the stock market going up, well, everybody thought, well, this is all wonderful. Very interesting thing though, very important point. Now what I'm doing is that a lot of this is the consumption change, an index this is the nominal annual change in U.S. GDP versus the absolute value of the U.S. current account. This is nominal GDP, and what we're talking about here, this is particularly consumption. So what you're seeing is the current account is going, this is an increase in, basically increase in borrowing. So what this is showing is that from the late 1990s, consumption, so you're seeing 300 and going up to 150, 100 to 300. So here, 300 to 450, 500, about 100 up to 300. What this is showing is that basically this is a borrowing. Effectively, the driver of consumption is just borrowing. That's the story here. But you're looking at the data, and the data is saying that basically this increase in consumption is driven by this increase in borrowing. So in other words, it's not real. It's not long-term. Because when you have, it's like if your consumption is increasing just because you're borrowing more money, you got to pay the money back. It's not a strategy. It's certainly a strategy. If a bank runs out, if the bank comes to you and says, well, here's Ichio Glen, go and spend it. Okay, you're going to go out and buy fancy cars and fancy clothes and take trips and have fun. But it's not real. And that's the point here, is that this consumption change, it's not real. Now we're looking at the collapse in the NASDAQ from its peak in early 2000 to its bottom in late 2000. And now what we're going to look at is see how the Federal Reserve responded to that. As we noted earlier, we've got 19, go back to here, we can see the decline in this is the Federal Reserve rate, the federal funds rate, so the decline there in response to the recession. Now we're looking here, and what we can see, the NASDAQ peaks, that's in adjusted term, that's inflation adjusted. It actually peaked at about 5,000, but in inflation adjusted terms it was 3,500. That's my the adjustment that I've made for that. And you can see it's right around early 2000. There's that peak, reaches that peak in early 2000. So and you can see how much it rose. This is 1999. This is 1 year. I haven't shown, I don't think I've clearly shown you, it was an incredible, that's 2,000 or 3,500 in real terms. In real terms, it went up 1,500. That's 75% increase in real, that's not inflation's on top of that. In real terms, it increased 75% in 1 year. That's crazy. It was a crazy year. This really, is even bigger than 1929. It was crazy. You people were you were very young then, but I remember that quite well. It was a crazy year. The prices were, especially from late in the year here. You see here. So just really, this late 1999, so about a 6-month, really is a 6-month period. You had 60, 70% increase in the index. That's not in an individual stock. It was the index went up that much. It was absolutely a crazy time. I knew people were trading. They were online trading. People were like they weren't going to work. They thought they were going to, they'd never have to go back to work again, because the market was doing, which is actually what went on here in 1989. That's what people in Japan thought in 1989 they'll never would have to work again, because they were just everybody's going to get rich buying stock. So the same thing was going on in the United States in the late 1990s. So you see. One of the things that's going on, see the Fed funds rate, they're starting to see this market go up, and they say, oh boy, we got to raise rates. They're increasing their rates above 6%. They're really worried. They're worried about this. They're seeing a bubble now. The Federal Reserve saw a bubble, but of course, typically by the time that you get to when the Federal Reserve responds, central banks respond, it's actually past, they respond too late. So and this is very typical with bubbles. By the time that central banks see that there's a bubble, it's usually too late to do anything about it. And that's very, very typical, because it's hard for many people, it's hard to tell whether it's a bubble or it's a boom until suddenly everything gets out of control. Because if you were here the summer of 1999, well, things are okay. And then suddenly suddenly you got this huge increase in prices. Then it really, by then finally, Federal Reserve realized, oh boy, we have a bubble. We have a problem. And bubbles are a problem because when bubbles burst, you can have economic collapse. You can have a real economic crisis as a result. They're not, an economic bubble is a serious event that if it goes too far, you can have a collapse in asset prices, which causes a collapse in spending, a collapse in investment. It can cause deep, the banks can fail. It's a whole, as we've talked about in the 1930s, what happened in the 1930s. It's a very serious problem. So, so they responded, but by the time that they're raising interest, well, I guess it worked. It worked because, you know, it started falling, and it came back, and then boom. So late 2000, it seemed to come back a bit, and then, oh boy, did it decline. So that was 3,000 to 1,000. That's like, in real terms, almost 70%, almost 70% decline in real terms. This was more than in nominal terms, more than 70%, and it would still get lower. So 2001, it would still get lower from there. This was the decline that was pretty similar, very similar, as I've shown you before, very similar to the decline in asset prices from 1929 to 1931 in the Dow Industrial Average. This is a collapse. That's a collapse of asset values. That is an absolute collapse in asset values. That's a potential crisis there. And so you can see, as that decline in the market is taking place, Federal Reserve is worried. They're worried they're going to have a depression. As you see, this is depression type decline in asset prices. So they're cutting, or 6.5% or so. They cut down to 2%. It's pretty low. That's historically, it was quite low. So 2%, they finally leveled off. It seems like things have finally leveled off in the stock market. Well, it kind of also, here was the, and again, this also was looking like a boom, an economic boom too. In 2000, you're seeing, you had, this is the Fed funds rate, the other side is quarterly GDP, almost 8% at the early 2000s. Economy is blasting. It's just exploding. It's all driven by borrowing, as we showed earlier, people borrowing money and spending. That's driving growth, and the increase, which was paper assets. So on paper, people were more wealthy, and so they're going out and borrowing and spending that money. But when the market collapses, that means that your personal, individual balance sheets blow up. And so in other words, individuals can become insolvent. And when you become insolvent, then people go from spending a lot of money to spending nothing. Basically to zero. So in just 1 quarter, this is 1 quarter, the growth rate falls to zero. So you've got the Fed funds rate. So the Fed is trying to, the Fed is trying to take care of the bubble, and then suddenly they realize now the economy's collapsed. So they're trying to raise the they're trying to raise the interest rates in order to control the asset price, but then the economy collapses. And one of the stories here, one of the very interesting stories, is that, and what we're seeing is that the Federal Reserve is trying to keep they had this one tool to try to control economic growth. And what we'll see is there's too many things going on. Too many things going on, too many different parts that are being affected. The rise in the federal funds rate stopped the growth of the stock market, but the growth of the stock market was affecting economic growth, so economic growth collapses to zero, basically to zero, and negative, so it's going negative. So now they got to cut interest rates, boom, 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 that's what they had to cut interest rates, and they set it down to 2%, below 2%, and then by 2002, the end of 2002, it's 1.5%. It's really low. They're really low, but what you can see is that you're not really getting a response in growth rate. It's not really quite, it's not, got a little bit here, 4% for just a couple quarters, and then it's back down, almost zero, 0 to 2%. This is below normal growth rate in real GDP. So this is, and again, that's annualized, this is quarterly growth rate, annualized GDP. This is low. This is low by historical standards. So, but it looked like it kind of stabilized. But now we're going to see creates another problem. So this is the problem, is you start to fix, it's like you try to fix one problem, and then that creates another, you have one problem that starts, you try to fix that problem, and then it creates another problem. So what we had was the stock markets going crazy. People are thinking, late 1990s, that tech, that the computerization, the internet, all of that is going to have a dramatic and immediate effect on economic growth. Just like people in the late 1920s thought that the electrification was going to have a dramatic and immediate effect, long-term effect on economic growth. And so it doesn't work. In both cases, that didn't turn out to be true. Stock market prices go up, people feel like they're getting wealthier, but it's just paper assets. It has an effect on economic growth. People run out and start buying things or borrowing money. The central bank gets worried. They start raising interest rates. It pops the bubble, but then the bubble pops, and now the GDP, the stock market falls, but GDP falls, so now they have to lower interest rates. Now, the difference between the early 1930s and the early 2000s is that another bubble pops up, and it's in the residential housing market. And this is the difference. And now we're going to tell the story, and this is how the Great Recession was different from the Great Depression. Because if the Great Recession had been managed in a similar way to the Great Depression, you would have had throughout the 2000s would have been a depression. You would have had a depression throughout the 2000s, and by now the world economy would have been pulling out. Instead, we ended up with a bubble, another bubble. And the bubble, because of Federal Reserve policy, whereas in 1931, the Federal Reserve acted to shrink, to actually contract the money supply. We recall from the last lecture, we talked about the contraction of the money supply that took place in 1931. Well, that caused a contraction in GDP. You contract the money supply, and they did it because they were worried about when Britain went off the gold standard in 1931, the Federal Reserve was worried about gold fleeing the United States, and so they reduced the money supply in order to control control prices. Of course, that had an effect of you drop the money supply, and it had a very negative impact. Early 2000s, instead of the early 1930s, the Fed has an expansionist policy. They're cutting interest rates, So the result, you see NASDAQ, this is the peak, and now it's declining. The cut in interest rates now begins, remember we talked about now the late 1990s, you're starting to get a boom in construction. Now the boom in the late 1920s, as soon as the Depression came, that boom ended, like overnight, literally overnight it ended, and it was gone. Didn't happen in this time. Because now this time, the stock market is collapsing, but there's a loose monetary policy because the Federal Reserve is cutting interest rates. They cut interest rates, as we see, to 2%. Let's see exactly, see when that took place. You can see that the federal funds rate, so late 2001. So cutting, late 2001. Now we'll go here to this, late 2000, let's see where that is. There's late 2001 right here. That's late 2001. And now you're getting all this period, the Fed's cutting interest rates. The more they cut interest rates, the more attractive the housing market becomes. And at the same time, there was also policy to encourage lending to residential housing lending in the US. So very aggressive public policy to encourage demand in the residential housing market. And what's happening? Housing market prices going up. And in fact, here we go. September 2000, as the NASDAQ, right when the NASDAQ started collapsing, real collapse, the residential housing prices passed their all-time high. This was the all-time high in the index. Remember what we showed earlier, 130. So look at this, we're at 130, 120. Let's just go back a little bit because we can see what that, is that? Yes, that's it. See that? And the 1990s, and if we go back more, see that? 115. So you can see historically where that was. If you look there, you see historically it's 105 to 115. It's a lot of the time it's in that era. And there's 105 to 115, 120. And now for the first time, now it breaks through that. Breaks through that point. And now the residential market, housing market, is continuing to rise. It's approaching, by 2002, it's approaching 150. So the Case-Shiller index, that's the real market, is approaching 150. That means you've had more than 20, about a 20% increase in real terms in just about 2 years. So this is September 2002, this is August, September, 2 years, 20% increase in real terms in the residential housing market, as there's a collapse in asset prices. And the economy's not strong. So this is basically another bubble gets created. Well, people didn't think that was a problem. For some reason, people thought, well, that's okay. They thought that was okay. Some of us in the real estate business thought otherwise, and I'll tell that story. So now we can. Now what I'm showing here is the comparison with that. We've shown this before. This is the Fed funds rate. We see the drop. Now you can see that. You look here, it reaches a peak. And now you see the rate gets cut. You're starting to get that rise. The rate is low. Now you get housing market bubble. Housing market bubble. Because the Fed had to cut the rates, this is historically extremely low. Very, very historically low levels, 1%. It's almost a record, in fact, kind of record lows. One of the things that, and in fact we want to, and a very interesting point, was until the mid-1990s, in terms of interest rates, of basically of low-risk interest rates. The lowest interest rates had ever been recorded in government bonds until about the mid-1990s. In history, had been in the 17th century, by I think the 1620s, in Genoa, in Italy, and it was about 1.6%. The Genoa government bonds traded at yields or interest rates of 1.6%, and this was about, I think, 1620 or so, somewhere in the 17th century. So you're talking about 300 years earlier. That had been the lowest interest rates that had ever been recorded in the history of finance. In the history of finance was that. These interest rates now are dropped below that. And in Japan, by the late 1990s, you had almost zero interest rates. So very extreme, it blew, so the interest rates were at these record lows, the bond market yields record lows. We are now in a new era, new historical era, something that had never been before experienced. So you've got these low interest rates. So they were trying to take care of the problem of the stock market. Now they're trying to take care of the problem of the low economy. But here's this now new bubble. So all of this now created another bubble. And here we go. And now the party is up. Now we got a new party. So this was what it was like living back then. It was one party after another. One asset bubble after another. And in fact, what we'll find out is that we ended up getting another asset bubble after the collapse of the market. So and we'll see what that has to do with going forward. So there's we got another bubble here. We've got to raise rates. It's been what you can. The way you imagine is imagine you're juggling balls. You know, a juggler. You got three balls up or four balls up in the air, and you know, and you can manage it. And then suddenly there's too many balls, and when you get to too many balls, they start dropping. And so this is what's going on. There's only so many balls that the juggler can keep in the air. There's only so much that the central bank can do to control the economy until something starts dropping. So here, now they got to rise interest rates to control this bubble. And you can see it's not having much impact. Why? Look at these prices are going up. The interest rates weren't high enough. Because they'd gotten so low, they're trying to raise interest rates. Look how steady increase from 1% to 5% in, let's see, this is May of 2004 to November of 2006, so about 2.5 years, and a steady increase. That's a 400 basis point increase. 400 basis points, 2.5 years. That's like more than 100 basis points a year. No, 200 basis points a year. It's 100 basis points every 6 months. It's like 15 basis points a month. That's like steady, boom, boom, it's steady. That's very, very steady increase. Basis points are hundredths of a percent. That's what I mean by basis. So 10 basis points is 1/10%. 100 basis points is 1%. So movement from 1 to 2% is 100 basis point movement. So steady increase. And they're trying to contain this bubble. Now but remember we were talking here, this was an all-time record. It had never gotten that high in more than 100 years. So this is 110 years of history here. And it never gotten, in real terms, the residential housing market in the US had never reached that point. Now, it's at 190. It goes up 50% more in real terms in just 5 years, 5-6 years. This, even by here, I started telling people, this is going to be a disaster. I was telling people in my industry, real estate industry, we knew it was going to be a disaster. Nobody else thought it. The Federal Reserve didn't think it. They thought everything was fine. But people in our business, even from here in Japan, I I could look and see. And in fact, I had family members that we talked about it, and I convinced some of my family members to sell their houses because I said, this is crazy. This is going to be a disaster. I could see that a disaster was coming. And as we'll see, 190. So it reaches that point. Now at the same time we got this construction share. Remember I said this was the late 1990s. It gets up to 4.7%. It still continues to rise. And you can see this steady rise. So you're getting this construction boom that's mirroring the rise in housing prices. So you're creating more supply. Now think about it. If for those of you that had my microeconomic class, and if you haven't had microeconomics, try to think about this. You have a supply curve, and it's shifting. The supply curve is shifting out. You're increasing the amount of the supply curve is shifting up. So you're increasing. It's shifting out. So that means prices should be falling. It should be falling. So if you're increasing supply. If you're increasing supply in the market, that's your supply. It's shifting out to the right. So holding everything constant, your prices should fall. That's what should happen. Prices are rising. So prices are rising. Interest rates are low. This is a bubble. This was a bubble like no bubble had ever taken place before. And what was going on in the U.S., the United States, it was going on at that time. Some crazy stuff was real crazy stuff. And I had, the interesting thing, I had I have a brother in Los Angeles that very interested. He's quite successful businessman, and he's also. He was also very interested in the residential housing market, so we would talk about this all the time. They did research. They were able to do research and find all of this, the lending in their local market, the crazy lending that was going on, the flipping of housing. People were flipping houses. Builders were building. It was all speculation. All of this is a clear sign of speculation. Because you're seeing an increase in supply, but the prices are going up. Prices are going up, supply is increasing, they should be going down, but the prices are going up even as the supply is increasing. Serious bubble. And as I say, I was watching this even from here, and I was telling people let's see, where are we? Right here. I started telling people here, this is great, this is going to blow up. I said, this is going to be a disaster. I didn't know when, but I said, this is going to be a disaster. Some people thought I was crazy, too. They thought, the guy doesn't know what he's talking about, you know. And that's funny, because a lot of people, they get excited about bubbles. They get excited, and it's those people that rush in to buy. That's why you have bubbles, because everybody's buying, and so now we're looking again. We talked about earlier the current account change and the consumption change, and the very close correlation in the current account. So increase in borrowing. So this is annual change. So you have a consumption. This is the annual change in U.S. GDP. In U.S. GDP, in final consumption. So in the GDP component of final consumption, that would be the C portion. We had that lecture earlier. We talked about the consumption. So this is growth. This is increase. And this is the current account, so this is essentially borrowing. So you can see that it's very close most of this change, and this is driving GDP growth and residential housing consumption, residential housing increase in housing prices. It's being driven by borrowing. So that's what that's showing here. You can see that kind of thing. And I remember when I was looking at these figures around this time, it's like, uh-oh. See, this is the kind of thing when you're an analyst and you're trying to say, hey, everybody, look at this. Anybody paying attention to this? I said, you can see, I looked at that, I said, this is some serious, it's all just artificial. This is the kind of thing that shows you that it's an artificial boom. Very artificial. So what you can see is we're heading for a disaster. What you can see is even then, some of us could really see that it was heading for a disaster. And what was interesting, it didn't just happen in the United States. It had happened in other countries. And one of the big countries that it happened was Ireland. And I had, was it last year or the year before? Somebody looked at Ireland, and they were interested in this period. I think it was, no, it was last year. Yes, last year a student did their, do you remember? I don't know if you remember that. You might not have seen. I know I gave people assignments. I don't, but one of the students did Ireland, and so they were looking at the residential market in Ireland in this period. Anyway, we're looking first with, so you started seeing, and Ireland had, so this became a global, it became a global event. It wasn't just in the United States, it was a global event. And here's Ireland starts taking off the late 1990s. So in fact, Ireland was, the economy was growing there. Ireland entered the EU. They had very favorable tax, a very favorable corporate tax, very low corporate tax. A lot of corporations set up their operations in Ireland to avoid tax. Most of the, for example, the tech companies in the United States, Ireland wanted to encourage the tech companies to locate their activities in Ireland. And so what they did was they set a very low corporate tax, 15%, the lowest corporate tax in the EU, to attract, basically what they made Ireland a tax haven. I mean, no, everybody says, oh no, it's not a tax haven. It's a tax haven. Ireland's a tax haven. It also became for pharmaceuticals. Pharmaceutical companies and technology companies. You're talking Apple, big Apple, a lot of, and what they're doing, they're setting up their tax structures so that companies like Apple are funneling all of their profits through, entities in Ireland. So they're making all the profits in the US, funneling the profits through entities in Ireland, and then moving that money to other offshore places, the Cayman Islands, British Virgin, whatever kind of places they can put the money. And that's how they're avoiding, these corporations avoid taxes. So this started having an effect on the Irish economy in the late 1990s. So Ireland now started getting, started becoming part of the boom. And in fact, there was an even bigger party in Spain. Spain had one of the great construction parties of history after in 2000, from 2000 before 2008. People and what was driving in Spain has very nice weather. If you're in Europe, most of Europe, if you live in if you've been to Northern Europe, the weather's terrible up in Northern Europe. I would never want to live up in Northern Europe. It's terrible weather. The Mediterranean's, most of the Mediterranean's sunny. And so Spain is a very attractive place. It's warm, it's sunny. People can fly down there from Northern Europe very quickly. So people, especially Brits, people from the British Isles were buying, and other places were buying up homes, and you had a construction boom in Spain, a huge construction boom. But we're seeing this, this is, let's see, I'm sorry, I should, sorry, I didn't, this is Spain. I'll have to put that, sorry, this is Spain, this is Ireland, and that's the US. So the US looks like it's not a big, compared to these countries, the US was mild. There's Ireland's going to 9%, Spain over 10% of GDP in construction in this period. That's crazy. Those are crazy levels of construction. That's not sustainable. It's way too much building. You're going to build way too much supply. There's going to be no demand. What's going to happen is they build all this supply and no demand. That was the coast of the southern Spain. All along the coast of southern Spain, that was going on. They were just building condos, incredible number of condos. And I assure you that when the market, and the prices were going up and up and up, and the building like crazy, when the market collapsed, the prices absolutely collapsed. Absolutely collapsed. In Ireland, they were building villages out in the countryside. They were building villages out in the countryside where they figured people were going to rush in and buy. It turned out they built villages that nobody wanted to live in. It was, you know, that was, but for a while everybody was buying them. Everybody was buying them. And if you want, and certainly one of the great things about working with students on projects like these is I get to go and look. I got to study the construction market. I did my own study of the construction market to understand what my student was doing, and it's crazy. You want to see crazy numbers compared to the size of the economy. Go look at the Irish construction figures for this period, 2000 to 2006. If you want to see something, you know, get online and look at what was going on. It's a great example of a bubble. Okay. Now this shows what happened. The collapse of the residential housing market. And in fact, this next crisis, now the bubble, as we said, 1930s, if we go back to the 1930s, remember the 1930s, the economic growth rate fell, market fell, everything stayed low. Everything went low. But here, you had a bubble. Another bubble, residential housing market bubble. We've shown it wasn't just in the United States, it was in other countries, it was in Europe as well. It wasn't here. And you're having it in China as well, but China's a different story because China's at a different stage of economic growth. We're talking about in mature economies. These kind of bubbles in mature economies. Of course, we didn't have it here in Japan either. Japan had its boom, and that was long in the past. But here now, as I said, I remember this period. I had right around this time. I had my youngest sister went out and bought a house in Southern California, and I said, "What are you doing? Sell that house. It's going to be a disaster." And she listened to me. They turned around. They sold it just before the collapse came. Just before the collapse. And they sold it to a neighbor. So somebody has to, but, I said, "You sell that house." And they listened to me. And they didn't get wiped out. They didn't get wiped out. I was also managing their money because I knew the stock market was going to collapse, and I put options. I didn't sell their stock. What I did was I bought options for them so that when the market collapsed, that kept them from losing any money as the stock market collapsed. So I was able to do that for them at that time, right in this time. As I say, I looked at that. I knew that you were going to get the collapse of the real estate market. You were going to collapse the stock prices. It was going to be a disaster. And personally, it was one of the easiest financial disasters to predict. It was so predictable. It was absolutely, and the people some people that made a lot of money shorting that market. And the amazing thing is that even here, most people believe that there wasn't a problem. Most people believe there wasn't a problem. So here it is. Look at this collapse. 195, 150, 100, a real collapse. And the construction market is contracting. So the construction market this is a contraction in the construction market. So construction dries up. The housing market falls. This is now the housing market crisis that became the Great Recession, the collapse of, and this is what precipitated the financial crisis of 2007, 2008 into 2009. What happened was the banks had sold mortgage-backed securities and things called collateralized debt obligations. They were called CDOs. And the collateralized debt obligations. There was all this commercial paper. There was a lot of commercial paper that was the collateral was the residential residential housing. So you had residential housing that was collateralized and turned into commercial paper, and a lot of this paper was given. The rating agencies here were saying it was AAA. They rated it as AAA. AAA meant it was the safest investment you could make. The safest investment, which meant it could have the lowest interest rates and the highest values. So when these prices collapsed, it wasn't just that the housing prices collapsed. It was the securities that had been connected to the housing collapse. And this was also something that was unique, or had never occurred before, is that from the 1990s, residential housing began to be securitized. That is, you created financial instruments that, so lenders were lending, the process, let me try to tell you the process here, so this makes sense. You have a lender, so you have a lender is lending to a house, so to household to buy houses. So that is an obligation that the household has to the lender. But then the lender is taking that loan, so they take the loan, and then they're creating, which is a contract between the bank and the household, and then they're creating, bundling the loans together to create a security, a mortgage-backed security, and bundling it, and they were selling, so they were taking these, creating these mortgage-backed securities, which they were selling to investors. So the investors were buying the securities that were the loans that were being made to the households. That's the process. This was something that had really never taken place before. This was a new aspect of the security market, was the creation of these mortgage-backed securities that were tied to residential housing. It had never really existed much before the 1980s. And from the 1980s, it had come into existence and became increasingly popular. And by the 2000s, it had become a big part of the investment market, were these investment-backed securities. So these investment-backed securities were basically leveraged because the loans themselves had very little, there was very little equity in the loans. So the loans, so you've got these securities that if you looked at them, it was all debt and very little equity. So it's all debt and very little equity. So what happens when you have, equity may have been, sometimes 0 to 20%, very, very, very low equity. Well, if you hold an asset that has like 80, 90% debt, and only say 10% equity, if the value of the asset drops 10%, it wipes out the equity. There's no more equity. So, and that's the value of the asset is based on the value of the equity, So if there's no more equity, and the assumption was that these prices would go up, and as it goes up, it creates equity. So the debt becomes, but instead the prices go down, and then it's called being underwater. So that the size of the debt obligation is greater than the value. The size of the debt is greater than the value, then the loan is it's underwater, and basically what happens is these securities quickly became worthless. They were rated as AA, they were rated as super safe, many of them were rated AAA. They very quickly, as this collapsed, they became worthless. And the banks were holding, investors were holding these assets. Banks were holding them. Other funds were holding them. The value of these assets was evaporating, and so that's what created the financial crisis. The financial crisis was created by this collapse in the real estate prices, because the assets that had been sold that were collateralized, the loans that were collateralized and sold to investors became worthless. So all these portfolios had no value. Suddenly, within months, many of them lost all their value, all the value. So that's when you had investment banks that went out of business. You had like investment banks like Bear Stearns went out of business, 2007. Lehman, everybody knows Lehman. The Lehman shock, everybody knows that here. That was 2008. So Lehman, Bear Stearns. Bear Stearns and Lehman. And they had a 2008 financial crisis. Absolutely. Now you've got the financial crisis that the world had experienced in 1930, 1931. So what's interesting is that, and remember, let's go back. Let's go back, because we're back to the previous. Remember what we talked about there? Remember that? Remember what we talked about? How it's Dow 30s, Dow 2000s, Nasdaq. This is 2001. This was, they tried to blow the bubble up. They kept the values relatively high, but then it converged anyway. So that's what happened. So what happened was that what happened was that in both cases, when you have a bubble, the bubble has to end. And if bubbles are created, there's going to be tears. You know, and basically, the Federal Reserve did their best to eliminate the pain. But the problem is when you have bubbles, and when they pop, when they blow up, there's going to be pain. It's unavoidable. And so what happened was the pain finally came. Remember, I showed you this, but now what I'm showing you is the underlying cause of what happened. And now we get here. There. So now we're there. That's how it all happened. That's how this financial crisis happened. It was a delayed, essentially what it was a delayed financial crisis. It was delayed from, whereas as in 1930, the crisis emerged. You had the banking crisis in 1930 to 1933. The Federal Reserve thought, okay, we did the right thing now. We did the right thing. You know, they cut interest rates. They didn't do what had been done in 1930, 1931. They thought they did the right thing, but instead they really were putting. They created another bubble, and which was essentially through a juggler. Well, they put more balls in the air. There were more balls in the air, and when they dropped, they dropped. it was just more balls and eventually it dropped anyway. And that's the kind of the moral of the story, that what we've learned from this is that you can't, when you blow up a bubble, the bubble has to, it's going to end in tears. At some point it ends in tears. And the problem is what we're going to see is that what happened here was, what do you think the central banks did in the end as a result of this crisis? They blew up another bubble. So this is the problem. And the problem is that, as I say, in the 1930s, they made mistakes, but they didn't blow up, they didn't keep on blowing bubbles. And the problem is these central banks, that in response to this, as we will see, they've ended up they blew another bubble. And that's where we're at. That's what we're at now. And that is, but what we're going to do is just look at that and see what the Federal Reserve's response to the collapse. As I say, and what we're saying, remember we talked about the balls up in the air. So all these balls up in the air, it is the Federal Reserve is rising interest rates because of the housing market bubble. They blew up a bubble, now they're trying to get rid of that bubble. Get rid of that bubble, but it didn't work. Housing prices continue to go up. Oh, it finally started working. Great. Oh no. It's a tough business. I would not want to be a central banker. And certainly to have been a central banker at that time. Very difficult job. Because really there's nothing, in the end, the central bankers thought they were very powerful. And what this proved is they weren't. They weren't powerful at all. They thought they could control all this stuff. They thought they could manage this. They could keep all these balls up in the air. Didn't work. Did not work. And we are talking now, this is a real economic collapse. I don't know how, if you were old enough to remember what it was like, you would have been, what, 10, 11, 12, around that age, around that time. You may not have been old enough to remember. This was, in my lifetime, the worst downturn. It was absolutely depression-like. You could see it was like a depression collapse, because you could see these economies were contracting, serious contraction. This is serious. This is 8% year on year. This annualized decline of 8% that went on right here. They're cutting interest rates, and you can see, what are they cutting to? 0. They cut the interest rates over 5%. This is historically normal. Historically normal interest rates. The problem is they've been blowing up bubbles, having the collapse of a bubble, blowing up another bubble over and over again. This has been going on over and over again. That's our story here. Over and over, blowing up bubbles, trying to keep raising interest rates, then dropping them, creating another to keep tears from happening. So then they create another bubble, and then they're trying so they're constantly trying to intervene and manipulate. And there's still tears anyway. That's a disaster. It didn't just happen in the United States, this was global. And the interesting thing is that it was much more widespread, because the world had become much more integrated than it was in 1930. 1930, 1931, 1933. As I showed you last week, the United States was the center of the Depression. A few countries declined in a similar fashion, but not that many. The US, Canada, of course, 1 or 2 Scandinavian countries, a few countries in Eastern Europe. Not Japan. Japan wasn't seriously affected by the Depression. Great Depression, early 1930s. A little bit, not much. Not much. Everybody was affected by this. This affected the whole global economy. Japan declined even more, about 9%. Japan's economy shrank 9% in 2009. That's collapsed. real serious, this was a real serious collapse. And the interesting thing is that here, this is the kind of central bank policy that the Bank of Japan had had for more than 10 years. This kind of almost zero interest rate. Almost 10 years you had that in this country, and hadn't really done much. And the problem is when you get here, when you get to zero interest rate, you run out of, in terms of your funds rate, and the funds rate is short term. So when we're talking about funds rate, we're talking about short-term interest rate. This is short-term. So your short-term interest rate, that's what we're talking about here. That's short-term. When you get here, there's nothing more you can do with short-term interest rate. You've run out of the policy. If this is your policy to control interest rates and to control the economy, when you get here, that's it. You run out of there's no more policy you can do with short-term interest rates. Now we can see the economy improves, but here's zero. So you're near zero. It's 2%. You know, there's 2%. You got a little bit here. But it's falling back, and it's really just around. It's slow interest, slow growth. It's low growth. So now you enter an era where they managed, and there was the dealing with the financial crisis. The central banks did it as well as they could under the circumstance. But the problem was that the resulting, after the crisis, economic growth remained very low. So you have low economic growth, especially in Europe, very, very low economic growth. And here's what we have, and here's the problem. 2008, we go 2008 to 2016. We're talking about this was just a little bit more than a year ago, and I wanted to update this, and that's something I'll want to try to do and update these when I get these to you later. I do want you to see what's happened in the past year, but you can see that the interest rates are almost zero. You reach this negative growth. We're already done. Well, there we are. Let's see how much more. I think I just have a few more slides. I just have a few more slides here. Okay. Well, I'm going to end this story next week. You're going to have your midterm assessment. I'm going to send this out to you on Saturday. There's the main parts of this. I'm going to want you to describe, basically going to be essays about the material that I presented to you in this first half through these 8 weeks, so that you have a picture. What I want you to is understand that picture of the effect of technology and economic growth. So I want you to understand the kind of picture that I've been trying to paint to you about these underlying forces in economic growth in the global economy. So we're going to talk about that, and then the other part I'm going to want you to outline your project and see where you're at. I want to get I want everybody to get going, and we want to now. For the second half of the semester, for people to focus on their work on that. So I'll send that out to you. As I say, that'll be Saturday at midnight. I send out. The clock starts at midnight so that's midnight Sunday morning. And what I'll do is I give my students 96 hours. To be at home. You can do it on your own whenever you get time in those 96 hours, whether it's the middle of the night, during the day, whenever I think. Does anyone have any midterms next week? you have, how many?
2.
You have 2? Because it's interesting, because I know before it all seemed to be in this week. So I'm curious, it seemed that all get done in the 7th week, but this semester it seems, anyway, it seems to be that way. You have 2?
No, only one.
You have 1, you have 2,
One.
you have 1, you don't have any.
I think I'm okay.
You're okay?
I think.
Okay. As long as, yeah, okay. Then we'll do that. We'll do that. And if there is any problem, let me know. I don't want, because as I say, I want people to take time to do this, and I try to do it when there's not the pressure that you have with the other tests, because this is kind of different. It's a kind of different approach. So, any rate, I will send that out. Let me know how everything is going. We got a small class, so we can, we can do adjustments here. So don't worry about that. I want you to have the situation where you can do well. And well, I'll be in touch with you. I'll upload this probably early tomorrow, and you can go over the lecture. And we'll see you next week, and we'll send that out to you on Saturday night, the midterm. Thanks.